Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we're taking a look at PayPal Holdings. As promised in the last video, they just had earnings, and we're going to see what's expected of them this year, where their valuation falls, and what to potentially do with this stock. So we see that it's currently trading around $60. In the last 52 weeks, been as high as 81 and as low as 50. Fair value we're coming up with is 113. Discounted cash flows 125. So we'd want to buy in 95 or lower, really, and we'd want to reevaluate around 124. Earnings yield is pretty low. They did have a pretty down year in earnings recently. 2023, only $1.34. They are expected to come in at $5.12 this year, though. $5.63 next year, which would be the best earnings per share that we've seen since 2019. Cash flow yield, they are strong on cash flow. It's trending down, but when you look at the actual numbers, they're still pulling in double-digit cash flow yields. So that's not bad. They had really high yields to start with. Dividend is non-existent. ROE looks good. Double digits, which is nice. 12% makes us question the equity. And debt to equity is coming out at 3.05, much higher than we'd like to see. We'd like to see it under 1, but PayPal is kind of banking and technology, so it's not really a metric that we can use for a banking stock. ROI 5%, ROA 5%. Both of those are pretty low. I mean, we've seen worse, but that's not the best. Margins are pretty good, though. Typically, they're around 50% gross margin. Recently coming in closer to 46, 14.77 net, coming in at 14.26 more recently. So the thesis we're coming up with is here. They came in over the last 2 years around 8% on average with growth. Analysts are expecting somewhere in the realm of 7 to 7.5 over the next 2 years. So we're going to stick with 7 going forward. Share count, they have been buying back shares pretty well. In fact, with such a low price, I wouldn't be surprised if this is 5%, assuming that they do the same dollar amount as they have previously. We could see this be much larger than it has been historically. Cash flows, I mean, we've seen in the negative 7s for the past 3 years. So we could stick with that. I don't know when we want to call a bottom. I mean, 12 is the lowest that we've seen, and that's what that negative 7 would be if they continue on the trend that they have been. You know, they started out at 25% back in 2020, and it's just been going down year over year. Assets growing at 5%, liabilities 7%, dividends are non-existent, and then margins, we just hope that they get back up to those averages. So assuming all this is true, and your purchase price of right now, you'd be looking in 3 years of fair value for the stock around 160. That doesn't mean that the stock is going to be there, but based on their earnings and their balance sheet and their cash flows, 160 would be a reasonable price to pay. I mean, that is, we're assuming that the PE ratio stands at what it currently is, which I think can come down. 32 is the lowest that we've seen. In fact, if they were to come in with their current expectations on earnings per share, at the current share price, they'd be trading at a 12 PE, which is ridiculous. If we adjust this and just do the 20, you know, we like to see stocks 20 or below for the PE. Assuming a 20, we'd be looking at $103 for the fair value. You'd still be sitting on gains of 73%, and in 5 years, you'd see that 130, 129 for 115% gains. And the average return would be about 10% a year. So that is a good return per year. The stock really dropped off. It was in 2020, $234, 2021, $188.5, and then it started declining. 2022, 71, 2023, 61. Right now it's sitting at 60. And so what we're looking at here is a turnaround where if they can stop the drop in their cash flows and potentially bring their margins a bit higher. They saw a bounce back from 2020's lows in their margins, but still they do have a little bit of room to go to get the net margin up to what we've seen previously. And those two things would likely reinvigorate this stock, make it something that people are willing to buy again. There's a lot of fear of competition, but they own Venmo. I don't believe that it's a dead company, as the market seems to be believing. And I don't think it's going to disappear anytime soon. Now we can look at the financials and see year over year, that revenue just keeps increasing. That's a nice straight line. That's what we like to see. 7% is not bad. It's better than a lot of the companies we've looked at. Cost of goods are growing in line. One potential issue here, gross profit, kind of topped off. 2021, 2022, 2023, not much difference there. Net profit, essentially the same. There's not a whole lot of difference between 2020, 2021, or 2023. 2022 was a bit of a dip. And then EBIT, it was on the decline and it bounced right back. In fact, 2023 is the best year in this time frame. Balance sheet assets just continue to grow. That's a great pace. Tangible assets are staying pretty stable. Looks like 2023 was right around the same mark as 2020. Liabilities, we're seeing the exact same trends there. Now, we'd like to see the liabilities level off and the assets continue to grow at a minimum, but we'll see how all this plays out. Cash flows, this is one area of concern. 2020 was the highest here, and aside from 2022 jumping up a bit, there is a pretty consistent decline across these cash flows, which is definitely something to keep an eye on. So at the end of the day, what we're looking at here is cash flows stop falling. Revenues continue climbing how they are. Ideally, liabilities don't outpace assets and growth, and they can get these ROI and ROA to higher numbers. What I'm doing here on this stock is I am trading and investing in it very slowly. I'm just using put credit spreads, trading on the stock. Back in April, I was trading on it, and I just continue to do so. And so far have netted $209 in profit. And I'm just putting that 10% of my trades are going back into shares so I can build up a bit of a position at this low point on the stock. So I am investing in it, just not really with my own money, just with trades. I like what I see, but I need to see a bit more to really go in on it. So looks like the market thought the same too. There was a bit of a dip off the most recent earnings. They were good. Great year-over-year growth numbers, but not quite what the market was wanting. And I kind of agree with it. They definitely have a few things to work on. But I want to thank you guys for watching. Please like if you enjoyed the video. Subscribe so you can stay up to date with everything. And I'll catch you next time.